What happens if the President-elect Donald Trump imposes a 25% trade tariff on Canada after his swearing in? Let's discuss. Friends, thank you very much for making my videos super successful. You are watching my videos in huge numbers. I am extremely grateful. And as you know that we have a promotion going on that when we reach 2,000 subscribers, we will pick one name from the list of subscribers and the winner gets a $250 Costco gift certificate. Along with this promotion, today we are also adding another big promotion that when we reach 10,000 subscribers, another name will be drawn and the winner gets Canadian $2,000 cash, which can be used towards your mortgage payment or rental payment. So there are now two good promotions happening simultaneously and both are applicable right away. You're already watching my videos in thousands and thousands, so please subscribe to get your name there. I wish you all the best for the same. And now coming back to today's topic. A very important development has come to light a few days ago with the declaration of the President-elect Donald Trump to impose a 25% trade tariff on Canada if we do not meet some criteria. Friends, I'm not a politician, so we'll not discuss why this happened and what will be the political implications. I work in the financial sector, so we'll discuss the financial aspect of this law should it happen. Now, the trade relations between the United States of America and Canada have long been characterized by mutual dependency and robust economic ties. The two countries share the largest bilateral trade relationship in the world, exchanging goods and services worth hundreds of billions of dollars annually. However, a sudden imposition of a 25% trade tariff by the U.S. President-elect Donald Trump on Canadian imports would disrupt this equilibrium, sparking significant economic, political, and social consequences. A 25% trade tariff would hit Canadian industries that heavily rely on exports to the US, including automotive energy, and agriculture. For example, Canada is a key supplier of crude oil, lumber, beef, and dairy products to the US. Such tariffs would make Canadian goods more expensive for American consumers, reducing their competitiveness and potentially leading to a decline in export volumes. Canadian lumber and Canadian beef, which are very famous in the United States and are being exported in huge quantities to the US, will face a huge downturn in their sales. Now, this could result in job losses, particularly in regions heavily reliant on US trade, such as Alberta, especially for oil exports, and Ontario for automotive exports. The Canadian dollar might weaken due to reduced demand for Canadian goods, increasing inflationary pressures domestically. Now, imposing these trade tariffs would also have economic consequences for the US. American consumers and businesses would face higher prices for Canadian imports from cars to construction materials. Now, this could drive inflation, reduce disposable incomes, and strain industries dependent on Canadian inputs such as home building due to expensive lumber from Canada. Friends, if you're liking this video, please smash the like button. You will never miss any of our informative videos in future. Now, if the US were to impose a 25% trade tariff on Canadian goods, the financial impacts would reverberate across both nations. The consequences would manifest in changes to trade balances, corporate earnings, capital flows, currency valuations, and investor sentiment. Now below is a breakdown of the financial implications for Canada first. Number 1. Trade and revenue impacts will lead to a decline in Canadian exports. Canada's exports to the US represent approximately more than 75% of its total exports. A 25% tariff would make Canadian goods less competitive in the US market, leading to a decline in export volumes. Key industries likely to be hit include automotive sector. Number 1. Canada's automotive exports, valued at billions annually, could shrink significantly, impacting revenue streams. Number 2 is energy sector. Crude oil and natural gas exports would face higher costs, reducing US demand for Canadian energy products. Then agriculture. Products like lumber, dairy and meat would see diminished US market access, and this reduction in exports would weaken Canada's trade surplus with the US, eroding a vital source of national income. Then comes corporate profits and investment. Canadian firms exporting to the US would experience higher costs due to tariffs, squeezing profit margins. To maintain competitiveness, Canadian companies may either absorb the tariff, which reduces earnings and limits reinvestment capacity, or pass on the costs to the US buyers, likely reducing sales volumes. Now, lower profitability and uncertainty regarding US trade policies could deter both domestic and foreign investment in Canadian industries reliant on cross-border trade. This would result in slower economic growth and a reduction in business expansions and job creation. Then we got to discuss Canadian currency depreciation and inflation weakening the Canadian dollar. The reduction in export revenue would likely weaken the Canadian dollar as demand for Canadian dollar increases in global forex markets. So as a depreciating Canadian dollar would make imports more expensive, contributing to inflationary pressures. Partially offset tariff impacts by making Canadian goods cheaper in US dollar terms, although this might not fully restore competitiveness. This will also lead to a higher inflation in Canada, much higher than it is today. The combined effects of reduced exports and a weaker currency could lead to increased inflation, as I already discussed. This would erode purchasing power and force the Bank of Canada to weigh the trade-off between raising interest rates to control inflation and avoiding further economic slowdowns. Then financial markets and investor confidence has to be discussed. Let's discuss the stock market volatility now. Canadian equities, especially in export-dependent sectors like energy, automotive and materials, could face sell-off as investors anticipate lower revenues and earnings. Now, which industries are the most vulnerable to this risk? Automotive stocks, as we talked, energy companies and forestry firms would be among the hardest hit. The S&P index and the TSX Composite Index could face downward pressure as market sentiment will turn extremely bearish. Lower economic growth and weaker government revenues might increase Canada's sovereign borrowing costs. If the tariff-induced slowdown impacts corporate earnings, it could also lead to a rise in corporate bond spreads as default risks grow. Now, investor confidence in Canada could decline, prompting capital flight to safer markets, particularly the US. This would exacerbate currency weakness and amplify downward pressures on asset prices. Then, if Canada retaliates with tariffs on US goods, in return, additional financial implications could emerge. Higher costs for Canadian importers will come. As a result, retaliatory tariffs on US goods would raise costs for Canadian businesses reliant on American inputs, further straining margins. Now, a trade war would amplify uncertainty, discouraging the investment and slowing growth in both the economies. Now, this all in turn could make the government budgetary strain and lead to reduced tax revenues. Lower corporate profits and potential job losses in export-driven industries would reduce tax revenues, increasing budgetary pressures on federal and provincial governments. And all this leads to increased public spending. To mitigate the economic fallout, the Canadian government might need to implement fiscal stimulus measures such as subsidies for affected industries or unemployment benefits. This could increase public debt levels. And then the long-term financial risks is the erosion of trade partnerships in both the countries. Persistent tariffs could incentivize Canada to diversify its trade relationships, leading to long-term shifts in capital flows as businesses invest in alternative markets. And if the tariffs remain in place, Canadian industries may need to restructure operations, relocate production, or invest in new technologies to compete globally. While this could lead to innovation, it would require significant upfront capital and financial adjustments. Now, furthermore, the U.S. exporters could face retaliatory tariffs from Canada as well. Canada has historically been the largest importer of U.S. goods, and retaliatory measures could harm American industries such as agriculture, aerospace, and manufacturing, which rely on Canadian markets. North American supply chains are deeply integrated, particularly in sectors like automotive manufacturing. A 25% tariff would disrupt these networks, forcing companies to either absorb the cost or relocate production, likely to regions outside North America. Now, this could lead to inefficiencies, job losses, and higher prices for consumers in both these countries. Also, this 25% tariff would strain the historically close U.S. Canada relationship, creating political friction and undermining trust between the two nations. Canada might pivot towards strengthening trade ties with other countries, such as members of the Comprehensive and Progressive Agreement for Trans-Pacific Partnership or the European Union. Additionally, such a move would raise questions about the viability of the United States-Mexico-Canada Agreement, the trade pact that replaced NAFTA. Unilateral tariffs would likely be challenging under the agreement, escalating legal disputes. And a tariff on Canadian goods could send shockwaves through global trade as well. Other nations might view the US and Canada as unreliable trading partners, prompting efforts to diversify trade away from the North American markets. This could weaken US influence in the global trade negotiations and embolden rivals like China. Possible scenarios and responses on what might happen. Number one scenario which comes to my mind is retaliation and escalation. Canada could respond with equivalent tariffs targeting politically sensitive sectors such as agriculture to exert pressure on US policymakers. This tit-for-tat escalation could spiral into a trade war, damaging both the economies. And number two thing which comes to my mind is negotiation and settlement. While faced with economic pressures, both these nations might seek a negotiated resolution, potentially involving concessions in specific industries or areas of dispute. And the number three scenario is long-term decoupling. If tariffs persist, both countries might gradually decouple economically, reducing trade volumes and shifting focus to alternative partners. While this would minimize future risks of tariff shocks, it would also erode the efficiency and cost advantages of North American economic integration. So, we can conclude that a 25% trade tariff imposed by the US on Canada would have far-reaching consequences, disrupting industries, straining political relations, and reshaping global trade dynamics. While protectionist policies might aim to boost domestic industries, they often come at the cost of broader economic stability. Given the deep interdependence between these two nations, such a move would likely harm both economies more than it would benefit them, making cooperation and negotiation the more prudent path forward. This hypothetical situation or scenario underscores the delicate balance of modern trade relationships, where actions in one nation inevitably create ripples across the borders, affecting economies and societies worldwide. Also, my friends, this 25% trade tariff imposed by the US on Canadian goods would create financial strain across multiple dimensions. It would reduce export revenues, weaken the Canadian dollar, elevate inflation, and disrupt financial markets. While some sectors may adapt over time, the immediate impact would likely be a slowdown in the economic growth in Canada, increased fiscal deficits, and heightened uncertainty for investors. The long-term implications could depend on Canada's ability to mitigate these effects through policy adjustments, trade diversification, and industry adaptation. And thanks, friends, once again for watching this video in full. And should you have any questions about the same, please feel free to call me back as you always do. Looking forward to all your queries and concerns. Stay blessed, keep safe, and see you in the next video with another topic very soon. Thank you.